Welcome back to Alpha Recap. We closed after a busy trading day on March 4th, 2026, and we've got a lot to unpack. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Lots of threads today. Margin pressure, concentrated momentum in a few names, plus a parade of 8K filings and a biotech licensing deal that caught attention.
So, what really stands out here is that there were two cross-cutting narratives driving action. Walk us through those.
Sure. First, margin compression re-emerged as a headline risk. Examples were AutoZone and United Health, where rising costs hit margins. Second, momentum was very concentrated. A handful of companies that reported strong quarters or got analyst attention finished the day noticeably higher.
Right. And the other thing is there were corporate filings and a biotech licensing deal layered on top, which created lots of event risk for active investors.
Exactly. The licensing deal was Antengene granting rights to a partner for a clinical asset with a meaningful upfront payment, and multiple 8K filings landed that deserve careful reading. Those things change near-term liquidity and can reveal material details.
Let's start with margins. AutoZone and United Health took center stage. Explain why margin pressure is a big deal right now.
When costs rise faster than a company can raise prices, gross and operating margins shrink. That cuts free cash flow, the money companies use to pay debt, buy back stock, or cover dividends. So even if revenue looks okay, margin slippage hits the cash generation picture and the valuation multiples investors assign.
AutoZone's issue was higher production cost, and United Health had a surprise surge in health costs. That's not the same kind of pressure, but both translate into the same pain point: lower margins.
Right. For AutoZone, it's manufacturing and input costs in the retail auto parts chain. For United Health, it shows up in the medical loss ratio, which is the share of premiums paid out as claims. A higher medical loss ratio directly reduced underwriting margins for the quarter.
So, if you're a dividend investor, this matters because free cash flow funds those payouts.
Yep. If margin erosion persisted, you could see pressure on buybacks or slower dividend growth. Defensive income investors should watch cash flow coverage and any management commentary about reserves or cost pass-throughs.
Short reaction. Short reaction.
Right.
Let's shift to winners. Aero Electronics, General Dynamics, and Hasbro were the momentum names. Talk about those moves.
These were pocket rallies tied to clear execution. Aero finished the day around $146 after a 6-month rally that was roughly up about 15%. General Dynamics traded around $365 and finished the day up after a recent gain of about 13%. Hasbro climbed to about $98 following a 6-month move up roughly 21%.
So investors rewarded solid Q4s in industrials, defense, and consumer cyclical names. I mean, when you step back and look at this, it's very sectoral.
Absolutely. That concentration tells you returns were driven by company-specific execution and guidance rather than a broad market updraft. Momentum players welcomed that, but the debate is whether those moves are durable or just multiple expansion on good news.
Bank of America upgraded Tesla to buy and set a $460 price target, which was another headline that moved sentiment. Explain why an upgrade like that can matter, even if it doesn't change the company's fundamentals overnight.
Analyst upgrades matter because they drive flows. Certain funds and managers follow analyst ratings or model portfolios. An upgrade can trigger systematic buying, especially among momentum and growth investors. But honestly, a price target alone doesn't change underlying execution risk in the electric vehicle market. It changes sentiment and can fuel short-term moves.
Yeah, that tracks.
And to add to that, some market participants treat those upgrades as flow events, good for a short-term pop, while others want to see changes in unit economics, margins, or delivery trends to be convinced.
Now, the other theme: filings and deal activity. Several 8K filings were lodged on March 4th, and Antengene struck a licensing deal. Give listeners practical guidance on what to do with those.
First, read the exhibits. An 8K index entry can look routine, but the attachments often hold the material meat: operating results, agreement terms, or special committee decisions. For small and mid caps, Those exhibits can change the risk profile quickly.
And the Antengene deal?
They granted rights to a partner and received an upfront payment of $80 million plus near-term milestones. That's classic de-risking. Antengene improved near-term cash runway and shifted development and commercialization risk to a larger partner, while future upside becomes milestone and royalty-driven.
So it's good for liquidity, but investors now trade future upside for lower near-term dilution or cash needs.
Exactly. For event-driven biotech investors, that's often attractive, but you need to price milestone risk and remember that ultimate commercialization value is now split.
Short reaction.
Yeah, absolutely.
Let's zoom out. Where did analysts agree, and where did they disagree on today's tape?
Consensus was straightforward. Margin pressure mattered, and company-specific execution drove outsized gains. Analysts agreed that 8Ks are potential catalysts. The debate was on sustainability, whether those rallies reflected durable fundamental improvement or were short-term repricing. Also, how acute margin pressure would be. Some thought pricing power would catch up. Others expected longer pain.
So for different investor types, what were the implications?
Defensive income investors needed to watch cash flow metrics and MLR disclosures. Growth and momentum players benefited from the rallies, but should set rules for entries and stops. Event-driven and biotech investors should treat licensing deals as partial de-risking and parse milestone terms. Quant and macro investors could exploit sector dispersion, the split between winners and those squeezed by costs.
Tactical steps?
Monitor supplier price indices and healthcare cost trends. Read the 8K exhibits before reacting. Be selective on momentum trades and use hedges if margin risk is concentrated in your portfolio. And watch analyst coverage for potential flow triggers. Upgrades can create liquidity events.
Okay, wrap this up for listeners. What were the 3 clear takeaways from today?
1. Margin compression was back on the radar, and it mattered for cash flow and valuation. 2. Momentum was concentrated in a few names that delivered clear execution or received analyst support, so gains were uneven across sectors. 3. 8K filings and the Antengene licensing deal created event risk and changed near-term cash dynamics for affected companies.
Final practical advice?
Distinguish durable fundamental changes from sentiment-driven moves. Read filings, not headlines. Size positions to reflect margin uncertainty, and consider protection strategies if you're exposed to companies flagged for cost pressure.
Great. If you want to follow up, we closed after a day that rewarded execution in pockets, but reminded us that rising costs can bite. Thanks for walking through that. It was really helpful.
My pleasure. Always good to connect the dots between the headlines and what actually drives cash flow and valuation.
If you have questions about anything we covered today, head to stockalpha.ai, or you can ask us directly, and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. We'll see you next time.